All right, good evening, guys. Ken at Tortoise Capital, nightly strategy podcast for February 10th, 2023. Stand by just for a moment. All right, so let's start with the update to the swing portfolio project here. We'll just go in alphabetical order on our swing portfolio. So this is Alcoa. Everything's on 30 minutes. The blue shaded area is the last 5 days. Um, the blue box is 10 days. That shows you the trading range. The yellow box shows today's price action on 30 minutes. And then this one just I include for reference of the size of the daily move and to be able to draw lines or whatnot if I need to. So Alcoa gave us recently a couple uh, uh, quick losses and then a nice stop and reverse here that really got moving. Missed the Kata 2. I took the second position here today. It closed weekly, and I like the way the PSAR is working here. I decided to keep this one over the weekend. I'll place a stop here so that that second position doesn't lose money. I felt like I was late not getting that in retrospect, and then I should have picked that up maybe sooner at the close yesterday rather than today. Um, but it is what it is. Cliff, Natural Resources, a steel company. So this one we had a nice little micro win. I missed the Kata 2 here. We played that as a breakout box. You'll recall that the market was uncertain and we didn't want to hold positions overnight. But the next day it broke down from the breakout box. We got a nice downward move. I decided to take this one as a profit on one to about plus 3R because I had the exposure in Alcoa over the weekend and I didn't want to have two metals open position on the short side over the weekend. So this one felt stronger than Alcoa because it was starting to climb out of the hole. So I just decided to lock in 3. So we've got Alcoa short, but we took the profit in Cliff. CVS. This was a Godzilla. We got after the gap up, we got this one long. It's coming into a little triangle here, so I think what I got to do is put a stop at 89.50. I'm willing to carry that one more overnight. In retrospect, this is actually looking pretty good when we look at the longer term. It clearly has had several opportunities to continue this fail, but it didn't. It had one effort long. It did not break down lower here, and then on the breakout box, it's been up and up. So I like the fact that it's got a rising lows and forming this little triangle right here. And I think next week there's a good chance that it gets to the 30-day high. That feels like the optimistic play at 94. I like our position, but I'm going to put the stop in here to lock in that gain. So bottom line, I still like CVS on the long side. Devon Energy, we played that one out of the breakout box here and cashed. Today there was a gap up and go. Played that as like a emerging dragon with the standard risk box. This was also an intraday sniper trade. And this one closed really well, so I'm willing to hold that overnight, over the weekend, and I'll put the stop like right here, and I'll be ready to add to that position next week upon any evidence of strength. Emerging markets, We got short yesterday on the breakdown with the standard risk box. It collapsed today and closed poorly. I'll have the stop right here to lock in, and I will look to add a position if it fails below the 10-day low. Mexico is basically just it's flat. There wasn't much movement around in here at all. It's forming a nice tight breakout box, so I think I'll be ready to go long from here or short from there, starting on the 3-minute as an intraday, and let maybe that grow into a swing trade. This one trades nicely during the day, so I didn't feel a need to hold that with any risk over the weekend. Brazil, same thing. I was looking for more of a collapse here, and then today it just started to recover. I decided to take the 1/2 of an R, and then just get ready for next week and reduce my over the weekend open risk. International paper has been good to us. Out of the breakout box here, we got the collapsing dragon, standard risk, another collapsing dragon, second position, closed at very weakly yesterday. I guess it was here. Then it gapped down and started cruising back up, and that just felt like a good time to get out of that one. So the first position had about 3R, so that one was 3, and this one had about 1R, so that's a total of about 4R. And then feeling froggy, I decided to go for the SSC on this one, because you will recall earlier this one had a earnings blowout, and from this stable base it really accelerated. So this feels like it could be holding support right here, and I'm willing to give that a try and to try to get a really nice entry on that. And so I will keep that stop here for probably 2 to 3 days and let this try to get some traction. It has to get to 39.50 first. Then if it gets through there, 40.50, and I like that one on the venture. I will stop and reverse. Like if this fails, then it looks like that would be rejected, and then it looks like that kind of a move down here. So I look at this as a critical state. There's reasons to believe in the upside because of the power of that earnings, but if it does break, I'll be ready to trade that as a tactical short. IT, still don't know what to think about this one. I like the fact that it's at about the halfway. This is like a fence sitter right here. It's not one of my usual suspects, but we had a nice trade in here before. But this would be an example of a fence sitter poised halfway between the edges of the trading range, and you have a nice tight risk box, and you could make a trade in either direction just inside that channel. And then if that breaks, that secondary leg down would be amazing, and if it breaks to the upside, that's like an all-time high, I think. So that one has potential. It could become something we trade more, but we'll see. Real estate, we cash this, cash that short. It's held nice support in here today. There's like a triangle forming. I think I could be ready to get long on this next week. And then a second position if it breaks above this. And I think short from here, aiming for this. So I didn't want any overnight exposure, over the weekend exposure, so nothing. McDonald's, we got out of that one on the one-day gift yesterday. It really did nothing today, so flat on that one. Marijuana, the nice collapsing dragon short. I missed the second position on that one. Today it started to recover, so I just took that for +2 and flat over the weekend. Clean energy also covered I missed the collapsing dragon's second position and maybe even a, on this one. And then it gapped down and started to recover today. I took it at the edge of the dragon and got out of that one for a about +2. This is, holding steady at that 10-day low where it's made a nice run before. So I just wanted to cash 2 while I could. I'm not swing trading the S&P on this one, but this is forming kind of that again, that fence sitter, which is a narrow range right in the middle of a trading range, in this case the 10-day. And you can make an argument why next week it could easily get to those two. And then when it gets to those two boundaries, it has something to decide. It would either be a continuation breakout or a reversion, or if it fails, it reverts or double bad ugly to the downside. So this is looking like a fence sitter and looking for some significant movements early on Monday. Treasuries. This was a what I think we took at the close yesterday, and paid off nicely today. And on that consolidation, right at around 103, I just decided to cash. And that's that's a +3 on treasuries. And look how nice and orderly that thing trades on the 30s. So I'm a fan of treasuries on the 30s. Tesla, haven't been able to get back. I think I missed that Z3 pinch move and the retracement right to that same support level. This now feels like it's ready to trade for me next week with a breakout to the upside. If it breaks out of the PSAR, I will be long with the second position if it breaks north of about 211. But if it breaks down from here, I'll be playing it on a return to 170. So I like that. I like that as a zero state compound critical state. And then finally, U.S. Steel. I cashed that one yesterday, which is nice because now we avoided all of this, but I didn't get that move. I was trading Devon Energy today, but this is setting up for a nice continuation breakout to the upside. And if it fails, though, it has to break below 2750 to be really interesting. So I would say the risk box looks like that. Breakout to the upside from here, breakdown below the collapsing dragon. That's your yellow zone right there. Okay, so I'm pretty happy with the swing this week. That we got some good work done. Shifting to sniper trade of the day. Here we have yesterday's close, gap up to here. Here's the peak of the opening range 3. This opened and started to take off, so we're long. Standard risk box here. This is in Devon on 3 minutes per usual. By that point, after 4 or 5 bars, you've got enough information to me to get that stop move from here up to about here. Get your risk out, lock in no lose plus dinner for 2, and then just start adjusting your stop from there. Check or hold. This little rollover here in price causes the R10 to roll over, so now you're on alert. That's why you need to get your stop up above your entry so that you can lock in that wedge. Standard exit, COTA 2 re-entry, standard risk box. Again, by this point in the trade, you have enough information to get your risk out. Again, no lose plus dinner for two. And we're noticing the warning of the R10 rolling over. Could you just put it right there because you had like a little doji action? Sure. That would be like a 1, 2, 3 exit, and then you'd be trying to lock in that extra piece, which would put you darn near 1R. So there's nothing wrong with that. Standard exit at the PSAR flip. COTA 2 re-entry again. I was very close to putting a double scoop back on because it's been kind of grinding, and this one was stronger than the first one, so that it gained a little bit more. So I was tempted to put 2, so I just kept 1. But standard risk box. By this point, once again, you have enough information to raise your stop up into here. No lose plus dinner for 2. Just turn it into a science project and see what you can get. Now here's where it got interesting. Because here, it couldn't even penetrate the dragon. There's that little buffer between it and the PSAR. And it breaks above that peak of the R10. So that's a very good sign. You'll notice that it went fall, summer. So this is really a strong sign. So that's the second entry. And then with 2 bars of gains, even though it's not much, you could still have your stop like right there if you wanted to lock in that second position. It's not much of a wedge, but you're not losing any money either, so there's that. And by that time you feel good. That's a good sign as well, because it flirted with failure here, but then it's starting to recover, and you've got that little protection against the PSAR, so you could actually move your stop up to the bottom of the dragon now. Like, I wouldn't be offended if you were here instead of here and lock in that extra piece. Standard exit. So 1 unit of risk. This first position gets 2. Second position gets about 0.5, so that's about 2.5. We'll take that. COTA 2 re-entry. Quick fail. COTA 2 re-entry. Quick fail, and that's enough for the day. So a reasonable piece of work here in Devon. It overall, from a distance, it had a pretty nice rise and held stable and closed pretty well. So Devon Energy going into the weekend actually looks pretty good, and oil and energy making a bit of a recovery today. it just so happened that those two exits were right at the critical state, and then you just got to accept it and get your reentry in both of those cases, right? Now let's take a look at the traders. This is Agnieszka trading the oil dollar on the 5 minute. Now notice she doesn't even get, the massive move of the day. With if you use the Z3 pinch as the standard risk box, which is about the size she has here, that was 1, 2, 3, 4, 5, and not even getting that though. She plays the collapsing dragon, quick scratch, collapsing dragon again for 2.1, doesn't take the kata 2, but even so, getting the hardest part of the day still brings home 2.1. So trade the part of the curve that is for you. And then on the Euro Canadian, couple quick scratches, quick loss, Z3 pinch breakdown, tries a quick second position, which scratches, but she brings home 0.8, and then when it resumes, she gets right back on and crushes it for 3.8 for a total of 4.4. That's a pretty good day at work. Nice job, Agnieszka. Satya, so he's working the 10-minute sniper here. I think he's working with my brother. There's TLT on the 10-minute. Here's everything comes into the station and starts collapsing to the downside, gets the short, and rides it to the edge of the dragon and brings home 4.1. It's like, what are your questions? Very nice. Here's, let's see, Woj on his normal Devon on the threes, brings home 0.2. A couple quick losses in here. And, he was a little quick to take the short. I was looking for rebounds and energy, but he got the same pieces that we did. Still is positive. Tesla, nice OR3 breakdown. I thought a little late on the SSC, but got the kata 2 to the downside and SSC to the long side for 2.5. U.S. Steel, quick scratch. This was late to get in. He finally couldn't help himself, and just in time for -1. Got some of it back, got the rest of it back for a scratch. Some days you have those days. Couple a quick scratch, a -1, a +1. Yeah, that's the standard play. But he does get paid in here for 1.8 and brings home 4.5. He was beating himself up a little bit, but I wouldn't. Just give yourself some credit for going to work, and you keep shoveling. That was pretty good. Now, Gary, I need you to look at reducing some of the complexity of your chart here, and I also want to show you something about the scale. All right, it doesn't look like you're using this part at all, and because you have the RL10 color coded, you actually don't even need that. And then I want you to expand your scale. So look how you've got all your price action compressed into about 30% of the screen vertical space. So all of this is unused, all of this is unused, and now you're trying to squint your eyes, and it's very hard to see price action in here. And so I would look to clean out some uh, of the unneeded portions here. I don't know that the 200 is doing you any good use. I don't know what the yellow line is. I can't read that. Um, that may help clear up some of the, the congestion in and around. Oh, okay, yeah. I would like you to show the chart the way you trade it as much as you can, but we don't need to see all of this stuff down here. That's because we can't really see the price action in here. But take a look at my Devon, and you can compare mine to yours and to Woj's. And I thought you did all right on this one. Quick one from my brother. Hey, Bill, I'm gonna unmute you there if you wanna talk through this one real quick.
Yeah, sorry guys. I got 5 screaming kids in my house tonight, so I'm enjoying the noise. Um, I did a video on this, and it'll appear in the long term in the Master Sniper course. But this was started off with a quick 1 hour loss. Uh, Watched it go down. That was actually stop and reverse. So then I got the 2 hour battle drill, and then it went all the way down and then retraced. So I got out there, stop and reverse, quick loss, right after 9:45. Then waited till it dropped back down below this red box here, and then got back in, second position there, third position there, stop and reverse, went back up. One thing I wanted to say about this is I've been experimenting with a new entry. This is not approved for distribution, but it's very interesting to me and might be interesting to you. Whenever this crosses back up out of the old oversold condition at -80, then it crosses up above the 0 line, which we found out this weekend is the most important line on the entire screen. That's the threshold between fear and greed. That's when I went ahead and did the stop and reverse right there. Then got a second position because it triggered, but then I don't know how that filled. And then it went up, came back down, and I got out there. Tried a long position, stop and reverse, got in again, then got a third position, and then got out. So this whole thing was about, I think it ended up being a plus 500, 450 or $500 in about just under an hour. But I have a video of this as I was going through it. I've already edited it down. Just waiting for the sensei to go over it, because I want to make sure that I'm explaining the things the way I can explain them the way I see them, but I want to make sure that they stay true to the foundations and our actual system. So it's a pretty interesting watch. I'm waiting for that approval. So back to you, Ken.
All righty. Got some housekeeping to do before we get into the weekend report. So, Greg, I saw was in here, so I wanted to answer his question from yesterday. Question was: is it better to have multiple close price targets bunched together, or better for them to be spaced out? Um, with room to move, I'm going to say there's information content in both of those. of a different kind. All right, so if I had something like a sell-off and a recovery, and now I've got something like I'm planning an MMRB here, so I want to get long there, and I'm looking backwards to see where are the price targets. So I might have I might have like a 10 period high and a regression line and a whatever, and I've got a whole bunch of price targets individually uh, estimated from different chart features over here, right? At some point, that just becomes, 5 different reasons why this price region is going to be very strong resistance, right? So uh, everybody that bought it in here then watched it fail can't wait to get out of this position. They just want to get their money back. And so if there were 5 different reasons for people to buy in here and it's all tightly clustered, chances are that when this gets up in here, these guys are going to be selling now to get their money back, and then this is going to act as a big resistance. Now, the breakout from that tells you that there's new buying pressure coming in for that breakout, and then the size of this leg from here to resistance could be duplicated and going over there. So the first answer is having really tightly compressed multiple price levels gives you a certain information about a lot of price action going on, a lot of decisions being made in that narrow range. My regular preference would be to have something like this where there was maybe a big sell off and then a big peak, and so now I got this channel. So now maybe I've got something like a collapsing dragon, and maybe this was just a quick run up like that, and there was no hesitation anywhere. And really, the first price break is all the way down here, and I'm comparing that to a tiny little risk box, and maybe I got 1, 2, 3, 4 to the downside. I really like that. I like to have them widely spaced out. What I can even do in there is say, look, hey, what if it only gets halfway down, like a Fibonacci 50% retracement? Then, the most recent strong move was from here to here, and so all the people that are making money on that are looking at this as a buy on dip. And everybody that watched that go up and didn't get a hold of it because they didn't want to chase are waiting for this thing to fail and then find support and go, which is the basis for that COTA 2, is you get that second wave of buying. So if I have a great big area in here where there is you look over here, there's no resistance or no support levels at all. I like to just cut it in half and give me a 50% retracement because I know Bollinger or Fibonacci retracement people would be kind of looking at that. So again, the difference between lots of little price levels from different reasons in a tight cluster gives you a certain kind of information. Having widely spaced price levels there was rapid movement in between them tells you something about really the space in between the price levels. When there's nothing inside there, it's not surprising if it just runs right ahead because there's no previous history of people making price decisions inside there. So that's what I would say on that. And then the bonus question was, let's see, are these prior support resistance levels more as a pulling force, resistance, or both? I just look at it as like cities on a road map, over in Germany with the Autobahn. The Autobahn between price congestions goes fast. When that traffic comes into the city, it starts to get slow and people are offloading and changing. Or if it was trains, This is that high-speed train between cities, and then it comes into the city for people to change trains and change cargoes because they're going to go off on different routes. So it's normal to see price congestion here, slow moving, grinding, uh, time being spent in the train station, and then fast moves between those price clusters where there's no support or resistance. Does this act like a magnet? I suppose. I just look, there's always buying and selling reasons that are pushing and pulling. I'm really just looking at price regions where we might expect different kinds of price behavior. So is it pulling or pushing? I would say yes. Um, those price levels and those regions are places where I'm not surprised to see price come up and start to fail, and that's where we engage that conceptual 2-hour battle drill, so that we, after we've made money in here, we want to guard that, especially if it starts failing at a price level that we expect it to fail. So find that 2-hour battle drill video, watch it every day for 30 days, and that'll give you important rehearsals on the most important decision you're ever going to make. And that is when you're framing these trades out and you see it's in here, and you get some kind of price signal that says the train is leaving the station, and you're aiming for a 2-hour trade. When that thing gets to 2-hour and then starts to fail, that should be the most rehearsed exit decision you ever make, because it did exactly what you wanted it to do under ideal conditions. So you had better rehearse that decision on how to manage hesitation at 2R, which means, where do I cut it? Do I stop and reverse? If I exit and then it resumes, how do I get back in? Is there still another 2R to the upside? So that whole 2R battle drill rehearses all the crucial decisions that you got to make at those congestion points. And since you know what those look like on the map, this looks like lily pads and frogs or trains, running, pause, jump, pause, fail, pause, jump. All of those congestion areas, the price behavior is similar, so you can rehearse your actions. How do I adjust my stop in between those support and resistance? How do I behave at the resistance and support levels? Treating them as critical states that I could either get an up or down movement. The least likely is a continuous sideways. It's much more likely that you're going to get a changing of the guard. Okay. Let me know if that didn't answer all your questions. Okay. So this video is posted on Patreon for you. This Jeff Boccaccio, our good friend of 15 years, he was on the board at the Society for Technical Analysts over in the UK. We did a little 90-minute podcast this week on Tuesday. So I thought it was a pretty nice interview. We had a lot of fun with it, a lot of foundational ideas. It's always nice opportunity to chat with Jeff. So bring that to your attention. I wanted to talk on this one. This is what I call the ARC Kathy Wood news effect. So she's legendary as the owner of the and chief trader and strategist for the ARC funds. Legendarily made so much money on Tesla and some of the biotechs and all that. So there was a news announcement right around in here about Kathy Wood, who's up, 40% since the start. Well, she was down 80% last year. She's up 40% from the start of the year. Is buying these 3 small cap names that are, next generation Tesla or whatever. And on this one, Organovo Holdings, had this extraordinary run up here, about a 25% gain. And then if you saw that and then read the news, say, well, I want to get some of that. And then today it suffered about, at this moment, 13.5%. It finished down to 18%. So you got to be very careful on these small cap names that just a little bit of news gets you all sorts of crazy price action in both directions, almost like the newspapers pumping and dumping. So that's why I kind of stay away from those small caps, certainly for intraday trading. I want something that has steady, routine volume that is tradable when it's normal. And then there's actually a strategy where you say, hey, let me find these. And the strategy we use in the sniper would be the fireworks, or we're looking at the 1 day movers, where it has a 1 day Z score, the size of the range, greater than 1 or 2 or 5, and when no more buying pressure comes in, the collapse of those things is as predictable as rain. So we got to be mindful of that. This one is a discussion I'm having with Chris White at Edge Raider, who's modeling our sniper stats. And we were talking about volatility. And as you know, in the sniper, there's two things. There's location plus volatility. So the first thing, it has to be at an extreme condition on location on these various patterns. Like the Godzilla pattern has got to be oversold on the 150-day look back, so it's got to be in the bottom 10%. And then on the 30-day, it's got to be in the bottom 10%. Then that gives us enough extreme abnormal location to suggest this thing is ready for a panic reaction in either direction. But then I want to see abnormal volatility. And so what we're doing is we're looking at the 5-day bins of the last 150 days. We're looking at what was the size of what was the price from the 5-day high to the 5-day low in each of those 30 bins. Then we find the maximum, the minimum, the average, and the standard deviation. And then we would normally think of normal volatility being average plus or minus 1 standard deviation. Or if we come over here and look at it this way, we would say if that was the max and this was the min and this was the average, then everything between +1 and -1 is kind of normal. And we're interested in when the 5-day volatility is more than 1 standard deviation of volatile or less than 1 standard deviation where it's very, very quiet. It turns out, though, that volatility is not symmetrical. That if I looked at it as histogram, this was the average. Volatility that 5-day range can only go to 0, whereas the fat right tail can really stretch much wider. So we can't use a definition of -1 as the start of abnormal. So I just basically set any time that the 5-day volatility is less than 0, I'm triggering it for quad. Even though it doesn't meet the technical definition that we use, this is just some secret sauce and practical experience. Because volatility is not symmetrical, you have to you want to see it on your screen as soon as it goes below average. But on the volatile side, you want to see it greater than +1 so that you're genuinely getting the fat right tail. So then if your location is abnormal, like in this case, and you have abnormal 5-day volatility, then you're going to have a Godzilla. Now, there's actually a way now to finesse this even more with the 1-day volatility. So you could have, if 5-day was volatile and the 1-day was greater than 1 z-score, then what you have is extreme volatility on 5-day and 1-day. That thing is fully in play. That means the 5-day move was large, and the last day, this 1-day, was also large. That is a thing that's in the middle of exploding, whether it's up or down. Similarly, if the 5-day was volatile but the 1-day was quiet, you would have had like 4 days of extreme range, and then the 5th day, this tiny little doji, and now that tells you, what's going on? It was raging, and now it's in a tactical pause. Was that the pause that refreshes that's going to give you another run, or was that the beginning of the sell-off like we saw in that small cap? So there is a world of difference between 5-day volatile, 1-day volatile, and 5-day volatile, 1-day quiet. This one in the middle, when the 1-day is just normal, you don't have any new information. It's not as interesting as these other two conditions. By the same token, when you have 5-day quiet, 5 days quiet, and then 1-day volatile, hey, that's the beginning of a breakout. And the 5-day itself is still quiet, but the 1-day was volatile. That means you are in the early stage of a breakout, and there could be more coming. So the first day is in play. Is there more coming? At the other extreme, the 5-day quiet and 1-day quiet, it's like the old movie, it's quiet. Yeah, too quiet. That means you have that abnormal silence, and now the smallest little noise of volatility is going to spook the herd, and that's when you see stampedes happening. And this is what an options player is really going to like. So what you really want to see essentially is abnormal 5-day 5-day volatility. You can then use an advanced rule of the 1-day volatility. You still prefer an extreme reading on the 1-day, whether it's very volatile or very quiet. You can still trade it as long as the 5-day is volatile or quiet, but you get extra juice if the 1-day is also very quiet or very volatile. So just a quick clarification on volatility in the sniper, and how that little strategy right there, I don't think you're going to find anywhere else on the web. That's some secret sauce for you. Okay. I watched a really good movie today by one of my favorite Japanese film guys, Takeshi Kitano. He's not for everybody. Very deep into Japanese culture and social mindset. And this movie, Hanabi, will make you cry. Remarkably sublime and melancholy on the topics of morality, mortality, and self-obsession. But the piece I wanted to share was that a film critic was talking about his style, and he said what is characteristic about Kitano is his movies are filled with watchfulness at all times, but stillness until the right moment. He is very, very present in a very still fashion. So he's watching the play unfolding on the screen, and there's the absence of action. It's very still and very mindful and present until it's punctuated with a sharp violent Yakuza gangster piece of violence, and then it's right back into the stillness again. And if there was ever a mindset that I wanted to have as a trader, it was characterized by that phrase: watchfulness at all times, stillness until the right moment, till the trigger is hit. Um, and I'm going to go up and binge watch some more Takeshi Kitano tonight, I think. I wanted to share that phrase with you. As you thinking about the mindset you want to adapt, that's sort of like the zero state for me. I've never seen it said better than that. I wish I'd said that, but there it is. All right, let's get to the reportage. All right, so we are bullish quiet. Had a little bit of a recovery today. Still holding mostly the globals, which has been a good play. We're ILF went below its 4-month moving average, so a little bit of weakness creeping in there. The volatility is still poised for an upward move, but we're getting close to the zero line. So we're still risk on, but getting cautious. In the regression line fractal, this is all daily charts. We have been tracking this recovery ever since this move caused the RL90 to reverse and start cruising higher. And that same move made the 270 stop decaying, get flat, and is now starting to gain a little more slowly. And then we're just noticing that there's still strength in that move because it's pulling, the 90 is pulling away from the 270. The 1030 pair have gone through a couple COTA 2 actions, but when you're looking at the longer term, that 90 versus 270 relationship is the same as the 1030 relationship, and you multiply that by 3 and 3 again, you get the 90 270, and that gives you that same you get the fast pair and the slow pair. So these are fractal. And one of the things we like to do is compare the 10 to the 270 to look at those extremes. And that sort of gives you the distance between the trader's price, which is at about 412, and the long-term buy and hold. There's that much distance. Back here, they were almost in perfect agreement. They were in perfect agreement here as well. And then this is how far the traders were able to move price away from the 270. It's now kind of at a peak. The last time it was that high, it did a little pullback and then held. So the question is, from this critical state, does it come back here and test? If the test fails, does it come all the way back to fair value? Or does it hold here and start giving you more of these legs up, knowing that the next target to the upside is this guy up here around 430? So we're at a compound critical state here right after 2 legs up from this COTA 2 low point and support. It's cleared this peak, so this is an interesting moment in coming into mid-February. Looking at the 3-day and the 9-day. 3-day has a very strong COTA 2. It has cleared this peak. It's holding above the dragon. If it resumes, you have reasons to believe it could get to 430. But your stop would be like right here. You want to preserve that. You want to preserve that nice move. The On the 9-day, this kind of caught a 2, and then the PSAR flip is holding, and are getting a slow, steady move. The 9-day is showing this at a really crucial price point right here. It's made that nice move off the bottom. Does it have another move in it to get to 440? That's the next leg up in the 9-day. So cautiously optimistic, but we are at a turning point. The train is coming into the station to take on more water and coal. Does it have more room? We shall see. Now we're looking at the daily health check starting with the 150. You can see prices at about the 70-yard line if that's 100. And that's about 50. And this is 0. Those two legs up. Now there's a slight pullback, and that's why I call this a compound critical state. This is the amount of normal pullback that you would expect from this push higher. In the same way that this little pullback resumed, now we're wondering, is this going to recover or does this fall back to here? So this is a really important moment. And to Greg's question about is it a magnet or whatever, I don't know, but it's like a train station where there's key decisions being made about the next leg of the journey. Remember, the last time it was there, after a nice run up, it failed. When it was here at that price level, it failed hard. So you're not allowed to be surprised if this fails. But if this holds, it then has to get through this peak, and then it's free and clear. So this is, remember, the upside is always characterized by climbing up the steps, and then all of the fails are characterized by jumping out the window. So these price actions are not symmetrical. That's why the collapsing dragon is our favored. So this is a really important support level right here. It's got to stay above 400, which is the 30-day low. And so that's today's price action right there. Compound critical state. Perfect for trading. The fish are getting ready to bite. You can see that orderly pullback now on the daily when we zoom in. Today it kind of bottomed out and closed well for the first time in a while, right at the PSAR. So there it is. What's it going to do? There's a big move in either direction ready to go. This is that next must-hold support level. I would say psychologically 400 is important too. That's that 10-day low. But really, in terms of stats, it's this one right here. And then to the upside, it's got to get above 415. And then above the 10-day and 30-day high, which was right here at 418. If it gets above 418, look out above. Longer-term blended monthly rebalancing portfolios, all the globals gave back a little bit this week, but they've had strong 1 months and 3 and 6 months. Only ILF is on the cash. You can see all of the U.S. down here. The strongest U.S. is mid caps, but even all the U.S. got smacked harder than the globals. So don't be confused by weakness in the globals. ETF 32 portfolio. Energy going through its typical cycling, its swing cycling here. And that means oil exploration and commodity funds are doing well. Short-term oscillations. This is actually pretty promising right here that the give back was actually pretty stable, and the month performance was still pretty good. I still see this as tech in the lead, whether you're talking about the Qs. Now, the Qs were a little more volatile than the S&P tech, so the old school conservative S&P tech was better. That's your Microsofts, Apples, Cisco's, and not the Meta and the Googles. Microsoft is the interesting one in that one to me. They are really throwing down the gauntlet of AI competition now to Google, coming out in public and saying game on. Inside the large caps, strong weeks from Boeing, Merck, Travelers, United Health. So maybe this is the return of the healthcare. So in the battle of the old school tech, so just compare Microsoft plus 1.8 for the week and 11.6 for the month, and comparing that to Apple, which had a better month but a much worse week. Mixed bag in the U.S. here, but you can see that the mid caps were the strongest U.S. sector, the large caps lagging. But Euro-Asia and Europe much stronger than the U.S. right now. EFA at 72 strength compared to the S&P at 52. That's a significant hat tip to the globals. Using that same logic, we're looking at the strength and consistency ratings here. The winners continue to win. The first newcomers in, home builders, showing a little bit of strength. Insurance and the United Kingdom. A little bit of weakness here in gold and dividends. So not much change this week. Winners continue to win. And now in terms of tradability, the ETF liquidity based on average daily dollar volume, last 30 trading days, we're looking at ATR percentage. The ones in the green are very liquid and very volatile on a daily basis. So energy, semis and biotechs, and discretionary, gold miners, Brazil, and oil exploration. All very, very liquid, very tradable for short-term targets. We'll shift to the daily. We've already seen those. We'll go right to dashboard 1. The little pullback has now given re-entry opportunities or buy on dip for the globals in both channeling and overreaction. The min pain, ExxonMobil, Merck has finally had some recovery. Oil, Walmart with a nice bounce, and Pfizer. Some weakness still here in Intel. I like them long term. I think the United States of America is not going to allow Intel to fail. So I think there's a value play in that one. I'm trading it carefully, though. Lots of auto framers in the Dow. And today's little one-day bump makes it a lot of 551Ws. Again, that's the pattern that looks at today's price compared to 5 weeks ago is up, compared to 5 days ago is down, so there's a little pullback, and then today was a white candle that closed higher than it opened, so you get 1 day of momentum, and then we normally frame that with a breakout above the daily high would be the mechanical entry, using a daily bar as initial risk, and then try to get the first day, actually the second day momentum, if we put it that way. ETFs showing even more of them as a percentage on the auto framer. Tons of 551Ws, all looking pretty good. Lots of good signals for you to choose from. This is a buyer's market. And you can see all of the mechanical framing data in here for those of you looking to learn how to do that with on the daily bars. And I just read it right from the top down to find the things that have the biggest move back to the 10-day high. There's some Intel, Brazil, the strong U.S. mid-caps looking good. Even treasuries around that list at 3.4 to 1. The S&P itself, 2.8 to 1. So this is today's little range compression actually sets the stage for a nice move, because you have a nice long bull and then a 10-day high and then some sell-off, and then today was a really small range. So when you're using the daily range as the risk box and the range is compressing, now you get a large, nice multiple back to the 10-day high, and that's why you see so many of these favorable. That failure to fail plus range compression is like a coiled spring, and it may either spring up or break down like a collapsing dragon for another leg down. That's what makes this so darn interesting right now in this compound critical state. So do not have a directional bias. In the Godzilla pattern, we got 4 still. All of them were pretty quiet today. Exceptionally quiet in EA. Look at that. That's the double stealthy Godzilla that I talked about. It's like in the bottom 2% of the 150-day, 30-day, and 10-day look-back period. But the volatility in both of them is exceptionally quiet. I just feel compelled to go look at that, if you don't mind. Sure enough. Yeah, that's failure to fail further in a tiny little doji. It's had 5 days to fail further, and it hasn't, and it compressed into this tight little wrist box. And just a move back to this level gives you 1, 2, 3. And then if it can break north of that, now you have this big gap to contend with. And this is where I would say you draw those extra, I'd divide that into 3 and say you got then 3 more legs before it gets back to normal. And then the breakdown, that fails in a hurry if that breaks. But really, gaming is the future in electronic arts. How do you not buy that at 111? That's got to go on the swing for next week. All right, so that's just I'll just talk myself into anything. I love that pattern to death. These are all the reasons why it's hated, but the lack of volatility says all the haters have left the building. So, and you'd see the same thing on TSN. And then this one, LUMN, is where it's had the 5 day pain and suffering and now has gotten all quiet. So maybe that run is done and it's ready for a new breakout. Standard list of movers are 1 day movers. Again, this is looking at the Z1, the 1 day volatility. And all of these are in green or one greater than one. There's some PayPal for you. VeriSign. And then in the most volatiles, we're sorting by the 5 day volatility, and things that are double green are ones that are really in play. So there's some gold in this mine on this whole strategy. I fully expect to be working on this for 20 more years. That's how good this is. All right, standard stats all across the board, and then the NDX gets us back to the top level look here. Energy, Merck and ExxonMobil and Devon. Big move in Walmart. I said we were going to look at that yesterday. I forgot to. Dang nabbit. This is going to be the one that got away. UVW. No, there's still room. That's actually really nice. I'm liking the holding support. This is at about the 60-yard line. That's about the 50. But it's got some clear targets to the upside, and support is in, and it's moved stronger than the market. It's had 2 days of upside volatility, looking really good. I'm going to add Walmart to the swing portfolio next week. And my brother likes ExxonMobil, so I would disagree with you, my brother. I don't think ExxonMobil is right in the middle. I think that is like a fireworks, if I'm being honest, because it's pushing the 150-day high, 10-day high, and 30-day high. You have an expansive 5 day volatility, and the 1 day closed really well. That thing's just ready to go. Yeah, oh, Walmart right in the middle. But yeah, ExxonMobil is pretty amazing. That's the. How do you not love that? Who's going to sell ExxonMobil? Gee whiz. If you want to just break your heart, look at this one on the intraday. Oh my goodness. Oh, nothing but a long train running right there. You want to get on the ExxonMobil bandwagon. Hold your nose. Yeah. That's what a fireworks looks like. All right, that's everything we got for today. We'll get this published and processed tomorrow morning. True Storytelling Circle at 8:30, and then swing patterns and whatnot at 8:30. Take good care, and if you're interested in personal application in the sort of like the minimum viable product to get trading with coaching, Griff Cooper's video that I posted on Patreon does a pretty nice job of laying out a really clear approach to mastering the kata 2 with a single symbol, and the process he used to turn that exercise into a personal rule set. He's pretty proud of his work. All right, take good care, guys. Get this published and posted.
Good night, everybody.